Good morning, everyone. I'm Rachel, and I welcome you all to Executive Corner Expert Talks. Today, I'm with Mr. Sunil Aranha, founder and executive director of Thincats. Here at 𝐾𝐿 we bring you industry leaders and successful business owners, market and equity advocates, all under one roof to help you discover the insights of the stock market and to help you understand how one can create multiple passive income streams. In today's show, we're speaking to the founder and executive director of Thincats. It's a pleasure to meet with you today.
Thank you. Pleasure to meet with you as well, Rachel.
Good to talk to you. So moving on to the first question now. The finance world has traditionally operated via banks. Peer-to-peer business is still a new concept for both lenders and borrowers. Would you like to talk about your inspiration to launch Thincats?
Sure. In fact, I should actually start with saying, while it is a new concept in terms of peer-to-peer lending being about 10 years old, in the fast-paced world of technology and finance-enabled or technology-enabled finance, or the fintechs, it's actually quite a mature business. So the first peer-to-peer was launched in the UK, I think in 2007 or 2006, pre the GFC. And I got involved with, as a segue, I got involved with it or understanding around the 2012 mark. And I was fascinated, and I thought all my Christmases have come at once. The concept of being able to help small businesses in Australia who have traditionally always found it very hard to get access to finance from the banking system, to be able to get the money from investors who would actually also be looking for yield in a low yield environment. And putting the two of those together on a platform and connecting them and giving both of them a good sort of result was something that was really quite exciting to me, to be able to bypass the banks as well. So I guess it's around the concept of technology and the growth in technology that allowed us to democratize finance. And my inspiration came from my 30-odd years of experience in banking traditionally and lending to small business, and knowing the gap between what they needed and what banks really gave them.
It's certainly a very interesting space to be involved in. Now, you provide an online marketplace to connect growing businesses with investors for a secured business loan. Now, trust is the most crucial factor in the finance industry. How do you ensure to build trust between the parties?
You're absolutely correct. And in fact, I guess we were faced with a dual challenge. One of being able to introduce a brand new asset class, which is lending to small business that had never existed prior. And two is to be able to convince borrowers that we were looking to help them with their growth finance needs in a competitive or with, in a way that would actually be something they could afford. And so we really did have a hard time in the early stages, but I think the key elements that led us to get the trust that we today have amongst both our investors and our borrowers comes from a combination of regulation, which was the ASIC award to us of an AFSL, and in fact we were the first people who got an Australian financial services license to operate a lending market or to operate a peer-to-peer marketplace platform as we do. And the other was transparency around everything we did. So what we actually do is our platform tells investors the story of why a borrower wants money, why they're good enough to actually borrow that money and repay it, their business plan, their CVs, their past experience, a financial spreadsheet that we curate and we convert from plain financial numbers into a way in which a lender might want to look at it, which really means how does it cover, or what are the ratios that cover your interest and the ratios that cover your debt in terms of repayment capacity. And we put all of that onto our platform and invite all of our registered high net worth lenders to view those loans that we've listed on the platform and then invest in them in a fractional way. So typically an investor who, let's say a loan for $100,000, would be funded by 20 people putting $5,000 each. And those 20 people are putting $5,000 in 20 loans. So in a way, they're diversifying their risk within an asset class of small business lending, and they're transparently able to directly lend on the basis of viewing a lot of information about a loan, which include financials, as I mentioned, and a whole bunch of other things, as well as an information memorandum that we put together. So there's a fair amount of work that we do in the platform, but for us, and we are quite unique in this respect, we always felt that it was important to maintain complete transparency to allow lenders and borrowers to actually interact in some form.
Excellent. Thank you so much for that explanation there. Now, could you please shed some light on the benefits that Thincats does provide to its clients?
Sure. So effectively, I guess from a borrower standpoint, it's access to finance that they would normally not get. And I'll actually make a differentiation here because there are lots of small business lenders, both bank as well as non-bank, who, and to separate the two, you'd find that with the banks, traditionally, they would lend money against security, which is usually the residential home and that sort of thing. And so if you've got a millennial who does not own a home as yet, but a very successful business, or a person mid-career trying to actually start a business that is under 2 years old, they can't get finance from a bank. However, there are lots of non-bank lenders that are involved in what is termed as business lending, but actually is more short-term emergency finance that is required to pay bills, like paying the tax man or paying, wages in the middle of a month. And so something to meet the cash flow gaps that are there when you have a normal trading operation. We actually don't do that kind of lending. Our niche is helping small businesses borrow money for longer-term growth, for longer-term positive outcomes. So what we mean by that is people acquiring new businesses, people buying a franchise, the fit-out that they would require of a shop or a restaurant or something that they're going to operate. All of those things, it's not easy to get finance, especially unsecured, as we're largely unsecured because we have a charge over business assets. And as we all know, when businesses go bad, there are no business assets. But we also have second mortgages where available on, on the borrower's home. So we're actually traditionally doing what is known as medium to long-term finance, which is 3 years to 5 years, essentially for growth purposes, where we can actually see that by borrowing that money, there have been positive growth outcomes, not the covering of past losses, if that makes sense. So that's for borrowers. From an investor perspective, or for a lender, it's an opportunity to look at an asset class that is quite different and has proven over a long time to be quite safe. Incidentally, in terms of our returns, all of our lenders have been able to generate a gross return over a 7-year or 6 to 7 years that we've been in operation of close to 16%. And that's, quite significant in our current market circumstances. And our losses have interestingly been very, very low and much lower than any of our competitors at less than 4%. So in a way, an investor has generated a net return of 12% on this asset class, which would compare quite favorably with most other asset classes, maybe except property and of course the volatile stock market if you're at the right end of it.
Excellent. And you mentioned some examples of your customers there. Are you able to elaborate on your current clientele?
Sure. So again, with borrowers, we fundamentally, we've got two customer segments, as you might have gathered by now. And so with borrowers, our borrowers traditionally are small businesses who might be, turnovers up to about, say, 3 or 4 million, who are looking for anywhere from 50,000 to about 300,000 as a finance source to actually, have a long-term growth. We also do short-term lending for those people who require money for short-term periods. We also lend which are interest only and principal and interest repayments depending on cash flows of companies. So we're very sort of I guess proactive in terms of understanding exactly what our borrowers need, and along the way we have quite a deep process of interaction with the borrowers to make sure we are giving them the right product, and so it's quite labor intensive in that respect. From a lender's perspective, I guess the typical lender is a self-funded retiree, actively chasing yield, particularly given bank rates are so low these days for their deposits or their fixed deposits. So most of our 150 odd lenders are high net worth wholesale people, either using their self-managed super funds or using other investment monies that they've got to invest in these marketplaces. But essentially, people who are looking for a fixed income return in some form for their everyday expenses and lifestyle needs.
Excellent, thank you. So now that industries are finally getting out of the adverse repercussions of COVID-19, what are your plans during this revival phase?
Rachel, interestingly, we had a very short period. As soon as COVID hit, we actually offered all of our borrowers relief, even prior to the banks actually, relief across both interest payments or principal and interest payments for a period of time. Interestingly, about 40% of the customers took up the interest and principal relief option, and some others, up to about 60%, took the rest. 40% actually didn't take any relief and did quite well, of course, because of JobKeeper and other government measures. So overall, we didn't see too much of a fallout, and now things that are coming back, we find that all of our businesses, and given the fact that we do a great deal of due diligence before we onboard a business, most of our businesses have performed fine. In fact, we've had no new losses over the last 12 months. So to that extent, COVID may not have impacted these people. What I feel we need to do, though, is take this opportunity to move forward and actually capture certain segments of industry that are crying out for more help or having difficulty getting help from the banks, and continue to do so. And we need to improve the way in which we actually serve the customer. And what I mean by that is technology has been advancing a great deal, particularly around open banking in terms of regulation opening up, and then technology matching in terms of what's available to smaller lenders like ourselves. There's a lot of predictive analytics that's available, and my dream position would be to actually get to a paperless lending transaction with an automated credit decision. So what that really means is a borrower applies online for a loan and goes right through and is able to get the money without actually having had to interact at all. And the great news is technology is allowing us to get to that point where we can improve that customer journey. On the lender side, we are actually already very, very transparent. So any investor on our dashboard or on our sort of platform can have a look real time online at all of the loans they've put money in, when their next interest payments are due, how much they've returned over the last 5 or 7 years that they've operated. At the end of each year, they can do downloads of all of the transactions and pass them on to their accountant so that they can get their tax returns done. And so we already offer all of that stuff, but what we don't offer yet is more smart reporting on people and their individual portfolio and investments. So that'll be a direction we'll take going forward. And we'll also start to look at broadening our lending base, not just to have the self-funded retirees as the investors, but also start to look at maybe small super funds and other sort of intermediaries or fund of funds who are looking for returns for their investors. So in a way, we can actually, there are some people who just don't have the time or the inclination to directly invest in every loan, but they would be quite interested in this asset class. And so we have to find a way of getting to them. So that would probably be the next step for us.
And apart from lenders, Thincats also consists of financial advisors. Could you explain how these advisors help both the lenders and the borrowers?
Well, in the advisor category for borrowers, it's really, their trusted advisors, whether they be finance brokers or commercial finance brokers, that is, as well as accounting firms, bookkeeping firms, and things like that. So we have quite a large number of referral partnerships in that space to access people and small businesses who are looking for finance. And in fact, that is only or our primary way of accessing the customer, because we're really a B2B business more than a B2C one. In terms of the advisory groupings for financial advisors, we are yet to actually come up with, as I mentioned to you, we're dealing today directly with investors. So we've not yet come up with a suite of products that will enable financial advisors to be able to sort of, benefit their clients at the same time as making a good enough return for themselves, especially in the funds under management sort of space. So we don't have an answer to the advisor sort of partnership process yet for getting funds in, but that's something we're working on.
And from applying for a loan till the repayment, everything's done in 6 simplified steps. Now, just to enlighten our audience, can you please talk through these steps?
Well, yeah, actually, it's really the first stage is, and I'm talking now about borrowers and their ability to access loans. So the first thing is they would apply for a loan, and so call that the first step. It's an online application, and the online application actually also has a number of permissions that are required. So we can get read-only access to a company's financial statements on Xero or MYOB or any of the software packages they might be using. We get access to read-only bank statements and some analytics around those bank statements to actually verify, the way in which their business is trading, and a whole bunch of other information that generally we get access to online. So the borrower really has to do nothing but, give us access. After that application, we actually start our due diligence, and as part of that, we interview and we speak with each borrower and truly understand what it is they're looking for, get a hold of their business plan, and understand, especially, for example, if they're acquiring a business, then we want to make sure that they know exactly what they're getting into and whether they've done their due diligence to the extent that they're protected as well. So we're kind of, in a way, helping small business do something that we know how to do, maybe better than a small business operative who's focused purely on running their businesses. The third step then is the listing of a loan on our platform, and we list a loan and then invite our 150 odd lenders to come in and bid on these loans. And again, if it's a small loan of $100,000 or $200,000, these days, in the old days, it would take maybe a week and a half or 2 weeks to get the investors to fractionally invest and participate and build up that book to fund the loan. These days, a $100,000 loan probably takes about, a half an hour to an hour to get funded. So that shows both the keenness of our investors in terms of chasing yield, as well as their trust in terms of the earnings that they've made from from this investment over the last few years. So after the listing, we have the funding, which is the fourth stage. And once the loan is funded, we issue a letter of offer. And once the letter of offer is accepted, we document it with our legal processes, and then we organize for the settlement and the funding of the loan. And we usually only pay money to the actual eventual point where it needs to be paid. So for example, if it's an acquisition, then we pay the vendor. So we don't actually give the money to the borrower. And effectively, the whole process takes, let's say, 3 to 4 weeks from the time a borrower sort of applies for a loan. which is still significantly less than what a bank takes to do exactly the same thing, really.
Well, thank you so much for giving us a fascinating insight into Thincats. Thank you for your time today.
You're most welcome. Thank you.
And with that, I will sign off for today. Watch this space for more. Till then, stay apprised and invest wise with 𝐾𝐿